Hi guys, today we will look into an investment class which is an alternative to the traditional fixed deposits, recurrent deposits, and also the debt mutual funds. Most of us will be having some amount or money sitting idle in our savings bank accounts, which we might need for the short-term purposes, such as if you are planning for a purchase of a car or for a purchase of a home. For paying education fees of our kids, we'll be parking these money either in the savings bank account or in the fixed deposits or recurrent deposits. I tell you what, the moment you park these money in these type of instruments, they start to attract tax right from the day one. If you are in the 30% tax slab, then they will be attracting 30% tax slab. The interest is added to your slab and it is taxed accordingly. So imagine if you are near the 30% tax slab, a 7% fixed deposit in a 30% tax slab rate will fetch you an interest around post-tax return would be around 4.9%, which is less than 6% if you take inflation into account. So you are losing your purchasing power of the money day by day the moment you park in these type of instruments. So what's the alternative to these type of funds? So enter arbitrage mutual funds. So in these type of funds, the advantage is that these are highly tax efficient. So since arbitrage mutual funds are taxed like an equity, so if your holding period is more than 1 year, then you no need to pay tax for the 1.25 lakhs of capital gains. So if the capital gains is higher than 1.25 lakhs, then you have to pay 12.5% as tax. So even if you redeem before 1 year, that is less than 1 year, and you will be attracting short-term capital gains, which is 20%, which is still efficient. So stop parking your money in these type of fixed deposits and recurrent deposits, and move your money back into the arbitrage mutual funds, such as most of the high income earners usually ditch the recurrent deposits and go for these type of arbitrage mutual funds. So let's look at the arbitrage mutual funds performance over the last 5 years. So be it any mutual fund, be it Invesco, Kotak, Edelweiss, and Tata, etc., most of these funds will give an CAGR of 6.7%, 6 to 7% on an average. So unless your holding period is less than 6 months, these funds never give negative returns. So you can be assured of a capital protection similar to that of offered by the fixed deposits and recurrent deposits in these type of funds. So comparatively, to emphasize the fact that these funds provide capital protection similar to that of FDs and RDs. So take a look at the absolute returns provided by these funds from 2022 to 2025. As you can see, there is hardly any year which has given these funds have given a negative return. So stop parking your funds in these type of traditional investments and get your money reclassified into these.
The added advantage is that you don't have to time the market in these type of arbitrage mutual funds. Whether the market goes down or goes up, it's irrelevant. You can park your money right away and then and there, and as long as your holding period is more than 6 months, they will start giving capital gains. So stop parking your funds in the traditional instruments and make use of the arbitrage mutual funds. If you find this content useful, kindly subscribe. Thank you.